In a world built on ambition and progress, a silent tremor is running through the foundations of our global economy. It's a feeling many sense but few can articulate, a subtle, unnerving hum beneath the noise of daily headlines and market reports. On the surface, growth appears relentless. Stock markets climb to new, dizzying heights, and talk of prosperity fills the air. Yet, this prosperity feels different, almost fragile, like a beautiful mirage shimmering over an unstable landscape. This illusion of strength is not an accident. It is the result of decades of decisions, a carefully constructed facade hiding a truth that is becoming harder to ignore. We are standing at the edge of a reckoning, a moment where the intricate systems that govern our financial world are being strained to their absolute limit. The story of how we arrived here is not one of a single event, but of a slow, creeping erosion of principles, a tale of ambition that has outpaced wisdom. And as we peel back the layers, we uncover a hidden chapter in our financial history, a story of power manipulation and lessons the world refused to learn. At the very heart of this fragility lies a single, inescapable problem: debt. For generations, the world has been on a borrowing spree of unprecedented scale. Governments, corporations, and individuals have gorged on cheap credit, mistaking the ability to borrow for genuine wealth. The United States, the traditional anchor of the global financial system, now carries a national debt so colossal it defies easy comprehension, soaring past tens of trillions of dollars. This wasn't a sudden development. It was a slow, deliberate accumulation, a quiet pact made with the future to pay for the comforts of the present. Every dollar borrowed to fund sprawling welfare programs, endless foreign conflicts, and stimulus packages designed to paper over economic cracks was a claim on future prosperity. For decades, this seemed like a sustainable model. As long as economies grew and interest rates remained low, the burden felt manageable. But the cycle has turned. The era of near-zero interest rates is over, and the cost of servicing this monumental debt is beginning to skyrocket, siphoning away resources that could have been used for innovation, infrastructure, and genuine progress. What was once a tool for growth has now morphed into a time bomb, ticking silently at the core of the global economy, its detonation drawing nearer with each passing day. The very mechanism that fueled our consumption-driven world is now threatening to become its undoing. This mountain of debt has not existed in a vacuum. It has been the fuel for one of the most speculative and artificially inflated market bubbles in history. The stock market, once a reflection of corporate health and economic reality, has transformed into something else entirely: a casino fueled by a relentless flood of cheap money. Policies like quantitative easing, where central banks injected trillions of dollars directly into the financial system, were intended to be a temporary life support measure after the 2008 crisis. Instead, they became a permanent feature, creating an environment where risk was rewarded and prudence was punished. This deluge of liquidity distorted price signals, pushing stock valuations to levels completely disconnected from their underlying earnings or future prospects. Companies, in turn, took advantage of low interest rates not to invest in research or development, but to borrow heavily to buy back their own shares. This practice artificially inflates earnings per share and drives stock prices higher, enriching executives and shareholders while loading corporate balance sheets with dangerous levels of debt. What appears as robust corporate health is often just financial engineering, a fragile house of cards built on borrowed money and speculative frenzy. Within this inflated reality lies a hidden danger. When the tide of easy money recedes, as it inevitably must, these over-leveraged companies and overvalued stocks will be left exposed, triggering a cascade of defaults and a market panic that could make previous downturns seem mild by comparison. The same forces of cheap debt and speculation have warped another fundamental pillar of the economy: housing. For millions, owning a home is the cornerstone of financial security, the American dream made tangible. But in recent years, property prices in many parts of the world have spiraled upwards, moving far beyond the reach of average income earners. This is not the sign of a healthy market driven by wage growth and household formation. Instead, it bears the unsettling hallmarks of a bubble, eerily reminiscent of the conditions that preceded the 2008 subprime mortgage crisis. Low interest rates made borrowing seem deceptively affordable, encouraging buyers to take on larger and larger mortgages. At the same time, institutional investors and waves of speculative capital poured into residential real estate, treating homes not as places to live, but as financial assets to be traded for profit. This combination has created a market where prices are detached from the real economy. The parallels to 2008 are stark, but there is a crucial difference that makes today's situation potentially far more dangerous. Back then, the crisis was centered on a specific segment of the market subprime loans. Today, the bubble is more widespread, encompassing prime borrowers, rental markets, and commercial real estate. The entire foundation is built on the assumption that property values will only ever go up. When that assumption shatters, the shockwaves will not be confined to a single sector. They will ripple through the entire financial system, threatening the solvency of banks, homeowners, and investors on a global scale. While these internal pressures build, an external threat is quietly gathering momentum, one aimed at the very heart of American economic power, the U.S. dollar. For over 75 years, the dollar has reigned supreme as the world's reserve currency. This privileged position has granted the United States immense economic and geopolitical leverage, allowing it to borrow cheaply and fund its deficits by simply printing more money, which the rest of the world was obligated to accept. But this trust, the bedrock of the dollar's dominance, is eroding. Years of fiscal irresponsibility, the weaponization of financial sanctions, and a ballooning national debt have led a growing number of nations to question the wisdom of tying their economic fates so tightly to the United States. A quiet but determined movement toward de-dollarization is underway, led by rival economic powers like China and Russia. They are actively seeking alternatives, settling trade in their own currencies, and building parallel financial systems that bypass the dollar-centric framework. More significantly, they are accumulating vast reserves of physical gold, signaling a desire to return to a system where money is backed by a tangible asset, not just the full faith and credit of a government drowning in debt. The decline of the dollar will not happen overnight, but the trend is clear and its implications are profound. A weakening of the dollar's global status would mean higher import costs, soaring inflation, and a dramatic reduction in America's ability to finance its way of life. The exorbitant privilege is slowly coming to an end. History does not repeat itself, but it often rhymes. As we stand on this precipice, the echoes of past financial cataclysms are impossible to ignore. The speculative mania of the Roaring '20s, fueled by easy credit and a blind faith in ever-rising stock prices, bears a striking resemblance to our own time. Then, as now, the belief that this time is different was pervasive, right up until the moment the market crashed in 1929, ushering in the Great Depression. Similarly, the 2008 financial crisis was born from a housing bubble inflated by complex financial instruments and a collective failure to see the systemic risk building just beneath the surface. In each of these cycles, the pattern is the same. A period of apparent prosperity driven by easy money and unchecked greed, followed by a sudden, brutal panic as reality sets in. We see the same hubris today in the belief that central banks can control the economy indefinitely, that asset prices can defy gravity, and that debt can grow to infinity without consequence. The lessons of 1929 and 2008 were written in the language of human suffering, lost fortunes, and shattered lives. Yet here we are, staring at the same confluence of factors: unsustainable debt, rampant speculation, and a system stretched to its breaking point. We have allowed the same cycles of greed and fear to take hold, setting the stage for history to deliver another one of its harsh but predictable lessons. Every indicator, from the unsustainable trajectory of global debt to the artificial froth in our markets, points to something larger, something inevitable. The silent tensions that have been building for decades are now converging, creating a precariousness that our complex financial architecture was never designed to withstand. We are approaching a moment of truth, a point where the world's financial illusion finally collides with reality. The breaking point is not a slow, gentle decline. It is a sudden, violent rupture. Imagine waking up one morning to a sea of red on every screen. Stock markets in New York, London, and Tokyo are in freefall, their digital tickers painting a picture of pure panic. Years of inflated asset values, propped up by little more than hope and cheap debt, evaporate in mere hours. Trillions of dollars in paper wealth vanish as if they were never there. This isn't just a market correction. It is a global margin call, and the world has no collateral left to post. The first domino to fall is a major investment bank, once considered too big to fail. Its collapse triggers a wave of counterparty risk, a complex web of obligations that suddenly unravels. Nations that had borrowed heavily in dollars find their currencies devalued overnight, making their debts impossible to repay. A sovereign debt default in one country cascades to another, as global investors, terrified of losing everything, pull their capital from any market perceived as risky. The very system of global finance, built on trust and interconnectedness, becomes the instrument of its own destruction. Panic selling isn't confined to stocks. It spreads to corporate bonds, real estate, and every other asset class imaginable. The sell-off is indiscriminate, driven not by logic, but by a primal fear of being the last one holding a worthless piece of paper. This digital panic quickly spills onto the streets. The abstract chaos of financial markets materializes in a very real and terrifying way: the bank run. Lines begin to form outside major financial institutions. But this isn't the 1930s. The modern panic happens silently, on millions of smartphones at once. Banking apps crash under the strain of countless users attempting to withdraw their life savings simultaneously. ATMs are emptied in hours, their screens displaying the cold final message: unable to dispense cash. The illusion of liquidity shatters. People realize their digital balances are just numbers on a server, promises that can no longer be kept. Banks, which have lent out far more money than they hold in actual reserves, are exposed. They slam their doors shut, electronically and physically, freezing accounts and restricting withdrawals to a few $100s a day. The trust that underpins the entire fractional reserve banking system is broken. Families who thought they were financially secure suddenly find they cannot access their own money to buy groceries, pay rent, or purchase fuel. The crisis of confidence becomes a crisis of survival, turning ordinary citizens against the very institutions they were told to trust with their futures. In their glass towers, central bankers resort to the only tool they have left. Faced with a complete freezing of the credit markets, the Federal Reserve, the European Central Bank, and others crank up their digital printing presses to an unprecedented degree. They flood the system with trillions of newly created dollars, euros, and yen, desperately trying to provide the liquidity needed to keep the lights on. This is quantitative easing on an unimaginable scale, a last-ditch effort to bail out a world drowning in debt. For a fleeting moment, it seems to work. The immediate collapse is halted, and the markets experience a brief artificial bounce. But this is not a solution. It is a fatal dose of the same medicine that caused the disease. The sheer volume of new money pouring into a broken economy has a predictable and devastating effect: hyperinflation. The value of currency begins to plummet not by the year, but by the day, and then by the hour. A loaf of bread that cost $5 yesterday costs $50 today and $500 tomorrow. Savings are wiped out. Pensions become worthless. The middle class is vaporized, their accumulated wealth turning to dust. The central banks, once seen as the guardians of economic stability, are revealed as architects of its ruin, and any remaining public trust in government or financial authority evaporates completely. The economic devastation inevitably leads to a social breakdown. With credit frozen and consumer demand gone, businesses collapse by the millions. First, the small shops and local restaurants, the lifeblood of communities, go dark. Then, larger corporations, unable to roll over their debt or finance their operations, begin mass layoffs. Unemployment numbers skyrocket to levels not seen since the Great Depression. But this time the social safety nets are already strained to their breaking point. The psychological toll is immense. Families who once had stable incomes and bright futures are suddenly thrust into poverty. The stress of financial ruin leads to rising rates of depression, domestic conflict, and social unrest. Communities, stripped of their economic foundations, begin to fray. The gap between the ultra-wealthy, who may have insulated themselves with hard assets, and the rest of society becomes an unbridgeable chasm. Protests and riots become commonplace as desperate populations demand answers and accountability from a leadership that has neither. The social contract, the implicit agreement that hard work leads to a better life, is irrevocably broken. The world is not just poorer. It is angrier, more divided, and more desperate than it has been in generations. As nations turn inward to deal with their own internal chaos, the era of global cooperation comes to an abrupt end. The interconnected global supply chains, once a symbol of efficiency, become a critical vulnerability. Trade wars escalate into full-blown economic blockades. Nations impose tariffs and sanctions not as strategic tools, but as acts of sheer desperation to protect what little industry they have left. The dollar, once the undisputed king of global finance, loses its status as the world's reserve currency as trust in the United States' financial stability collapses. In this vacuum, new alliances begin to form. Seeing the West's self-inflicted implosion, nations like China and Russia, along with their partners in the BRICS bloc, accelerate their plans to de-dollarize. They move to establish a new financial order, one backed not by the full faith and credit of a bankrupt system, but by tangible assets. They unveil a new trade currency, perhaps linked to a basket of commodities or even gold. This isn't just an economic shift. It is a seismic geopolitical realignment. The balance of global power, which has defined the world for nearly a century, tilts decisively away from the West and toward a new, emerging coalition in the East. Out of the ashes of the old system, discussions about a great reset begin to take shape. But what this new world economy will look like is a subject of intense debate and conflict. One vision proposes a highly centralized system of central bank digital currencies, or CBDCs. In this world, every transaction is recorded on a government ledger, giving authorities unprecedented control over how and where citizens can spend their money. It offers the promise of efficiency and stability, but at the cost of financial privacy and individual freedom. An opposing vision calls for a return to sound money, a system backed by a physical asset like gold. Proponents argue this would enforce discipline on governments and prevent the kind of reckless debt creation that caused the collapse. It is a return to a system that values tangible assets over abstract promises. This conflict over the future of money represents a fundamental clash of ideologies: centralization versus decentralization, control versus freedom. The outcome will determine the economic landscape for the next century, shifting global financial power and rewriting the rules of wealth and value. Yet, as humanity stands at this crossroads, a haunting question remains. Are we learning from our mistakes, or are we simply choosing a new and more sophisticated way to repeat them? History doesn't repeat itself, it reveals who learns and who doesn't. What comes next isn't just an economic reset. It's a test of how much truth the world is ready to face. If you want to continue exploring the forces that shape our world, make sure to subscribe and click the notification bell. And if this perspective gave you something to think about, please like the video. Your support helps us keep asking the important questions.